Hey traders, I'm Loaded Forex, aka No Signal, No Entry. In today's video, I will show you the 4 pillars of successful trading. The first one is the profitable system or strategy. The second one is the risk management. The third one is the patience and discipline, while the fourth one is the money. Every successful traders you see out there, we all started with the fourth step, which is totally wrong. And that's why a lot of beginner traders struggle to make money for a very long time before they transition to profitable side of trading. The first thing you have to understand is to get a profitable strategy. You can learn from any Forex mentor you can trust, you can relate with, that you have been watching his track record for a very long time. Learn and master the trading skill first. The second one is the risk management. After you have mastered this profitable system, then you have to sit yourself down and structure a professional risk management approach to your trading. If you have a $1,000 account, for instance, you need to ask yourself, out of this $1,000 account, how much am I willing to risk? How much am I willing to let go? How much am I giving to the market on a single trade? And this risk will not affect my daily activities. It will not affect my sleep at night. That is risk management. You might have been hearing that you are not supposed to risk more than 1% per trade, 0.5% per trade. No, I don't believe in that approach. My own definition of risk management is that how much you are willing to risk that will not affect your sleep at night. That is risk management. My own risk management on $1,000 can be maybe 10%. That is my own risk appetite. Another trader's risk appetite on the same $1,000 might be 2% or 1% or 0.1% or 0.5%. So the most important thing is, to master this risk management, you have to understand that how much are you willing to risk on a single trade or in a day that will not affect your other daily expenses. Once you've structured a professional risk management, the next thing is to acquire patience, which is the third step, third pillar of successful trading. Patience and discipline. The reason why a lot of beginner traders are not making money is that they don't have enough patience to wait for days, for weeks, or for hours for price action to come to their point of interest before they execute. A lot of beginner traders, they just want to enter the market now. Either the market is at the point of interest or the zone where they want to buy or sell. They just want to trigger their position. Trading doesn't work like that. Patience and discipline is one of the most difficult skills to acquire in trading. It's not even about trading, in life generally. Once you master patience, that you don't care what the price action is doing, I must wait for price to come to my zone before I trade or before I trigger my position. Once you acquire this skill, it will help you to make money, which is the fourth step of successful trading. But if you don't want to follow these steps in order, you will never make money. You end up giving up in trading, because we all started from the fourth step before we realize that we are doing the wrong thing. If you are starting from the fourth step, which is the money, you will end up not making the money. But you have to start from the fourth step, which is getting a profitable system or strategy with edge over the market. Master this system over and over. Test the system for a period of 3-month data or 6-month data to know whether the system is working or not. Don't forget, no strategy is 100%, but at least master a strategy with higher win rates. Once you master this strategy, then structure a professional and a well-structured risk management. The third one, be patient. You must have patience and you must be disciplined to wait for your setup to show up before you execute. Then, these first 3 steps will enable you to make money. The fourth step or the fourth pillar of successful trading. In today's video, I'm going to show you how to master all these 4 pillars of successful trading, how to understand my own profitable system that I've been using for many years now. I will show you professional risk management approach that I use all the time, and then I'm going to show you my money blueprint management approach. If you found value in this video, don't forget to smash the like, subscribe, and turn on the notification button so that you can get notified whenever we upload another exclusive video tutorial like this. And if you want to be a part of our free signal on Telegram, where we give out profitable signals every week, you can click on the link below this video description and it will take you to our Telegram community. And I will see you after the intro. There are 3 steps that I use for my profitable system. The first one is the structure. I have to understand where the price action is heading to. Are we heading to the downside or we are heading to the upper side? And if the price action is trending up, it's a sign that the buyers are the one in charge of the market. And if the price action is trending to the downside, it's a sign that the sellers are the one in charge of the market. So I have to trade along with the current market sentiment. On the daily time frame, the structure of the market is bullish. That shows that the buyers are the one in charge of the market. The price action was trending to the downside from this zone here, whereby the price action created this high, lower low, lower high, then lower low, lower high, lower low, lower high, lower low. This place was the last low before the buyers took charge of the market and they pushed the price action to the upper side. And the buyers invalidated the structure. Right? They invalidated the structure to the upper side, whereby the bearish market structure is no longer valid anymore. We're now back to bullish market structure, whereby we're now having this pattern, higher high, higher low, then a new higher high. So what are we expecting right now? We're expecting price to give us another pullback phase before price give us another expansion leg. Looking at the price action right now, buyers are the one in charge of the market. And the second step is to establish your POI. What do I mean by POI? Point of interest. The zone where you want to execute, where you want to buy or sell as a trader in the market. So in this current price action, we are taking buy setup only. We don't have any business with the sellers. We just want to trade along with the buyers in the market. So where are we executing our trade right now? We have to establish the recent key level that was invalidated by the buyers. This zone was serving as the last key level zone before the buyers invalidated the structure to the upper side. Looking at the establishment of our point of interest around this zone now, it's a sign that we are doing the right thing, right? How do we confirm whether this key level zone serving as our point of interest is valid or not? We need to check the historical events, what has happened in the past when price action first sold to this or first bought to this key level zone that we want to use as our point of interest. From this zone where we have to extend this our key level to the left side. Now if you look at what price action did as at 19th December 2023, the price reacted at our point of interest, right? Price reacted around this zone here. Price also reacted around this zone here. Price reacted around this zone here. We need a minimum of 3 requirements, 3 touches before we can conclude that our point of interest or our key level is valid or not. If the price reaction at the key level we want to use is not up to 3 times, don't use it as your point of interest. Only use key level that price has reacted more than 3 times or a minimum of 3 times. And if you fast forward it to this zone, price reacted here again 4 times, 5th time, 6th time, then 7th time here, then finally to the current price action. Price action reacted here, reacted around this zone here. If the price action is coming back in the future to give us a pullback phase down to this zone, there is high probability that price action is going to respect this key level zone for possible buy opportunity. After establishing our second step, remember I said the first step of my profitable strategy is to establish the structure. The second one is to establish the key level where you want to execute. The third step is now the entry. You might have watched different kinds of videos on YouTube whereby some people will tell you set your pending order and forget. I'm not that type of trader. I'm the kind of trader that I want price action to come to my point of interest and I want to see price action reaction at my point of interest. I want the price to talk to me before I execute my trade position. So what time frame do we use for our third step, which is the entry? Sometimes we use 4 hours time frame. You can use 1 hour time frame, 30-minute time frame, 15-minute time frame. Those are the 4 time frames that I use for my entry. So if I check the price action on 4 hours time frame and I'm unable to see entry, I'll scale down to 1 hour. And if I'm unable to see entry on 1 hour, then I'll scale down to 30 minutes or scale down to 15 minutes. On the 15-minute time frame, this is where you need to apply risk management when price is about to reach your point of interest. Before price action comes to your point of interest, your preparation matters a lot. What are the things you've done, rules you've set for yourself? Okay, if X and Y did not come together, I will not execute my trade. If Z and A did not separate, I will not execute. These are the preparations. These are the rules you set down for yourself. What will give birth to a successful trading is your preparation. Now, for instance, let's say you have a $1,000 trading account. The risk management is very, very important. And that is why you need to ask yourself this question. On $1,000, how much am I willing to risk per trade? You know, it's not about whether you are risking 1% or 0.5%. It's all about how much you can afford to lose on a single trade or in a day, so that it will not affect your emotion, it won't affect your mood, it won't affect your sleep at night. That is why proper risk management is very, very important. The question you need to ask yourself is that on this $1,000 trading account, how many trades am I going to take before I blow this account? That is the first question you need to ask yourself. That is the first preparation. Before price action comes to your point of interest, you have to ask all these questions. How many trades am I going to take before I lose this $1,000 account? For instance, let's say Mr. A or trader A break his own risk management appetite that, okay, it will take me 10 trades before I blow this account. So if it's going to take you 10 trades before you blow this $1,000 account, that means you will be risking $100 per trade. And this $100 per trade times 10 is going to give you 10 trades. It will take you 10 trades before you lose this whole money. And if you know what you are doing, and if you are using a profitable strategy with hedge in the market, there's no way you can lose 10 trades in a row. Are you going to lose? Are you going to experience drawdown? Yes. No strategy is 100%. The most important thing is it is not how much you lose that matter. It is how much you make when you are right. When you are wrong, you have to lose less. You have to make sure that you are losing less. You are cutting your losses. But when you are right, you allow the profit to run. You maximize, you take advantage of that opportunity so that you can win big. But beginner trader, when they are wrong, they allow the losses to compound. When they are right, they cut their profit short. So I'm going to give you a profitable approach to master your risk management. Trader A, risk appetite is $100. It's going to take Mr. A or Trader A 10 trades before he blow his account, right? And these 10 trades, these are the rules, these are the preparation you must put into consideration, that no matter what the market is doing, even if I lose my first trade, second trade, third trade, I will still be risking 10 trades because you have structured your mind that you are only taking 10 trades before you blow your account. Trade 1, you lose. Trade 3, you lose. Trade 4, you lose. Then the trade 5, then you increase your risk from $100 to $300. Then you are not a disciplined trader. That is what is going to help you to master step 3, which is discipline and patience. So let's go to babypips.com. You type babypips.com. You go to position size calculator session. Then you put your $1,000 trading account here. Then you ask yourself, Trader A risk management appetite is to risk 10% per trade, and 10% per trade amounts to $100. So the question is that what is going to be your stop loss, which is the last option to fill here. Stop loss pips vary sometimes. Sometimes there are setups that is going to give you 10 pips stop loss, others will give you 20, 30, 50. So you can't just use one approach for your stop loss, right? So let's assume that on this trade right now, when price action comes to our point of interest, we are only risking 25 pips, right? So you come to your position size calculator website, you put 25 pips, then you click on calculate. So are you going to see the result here? The amount at risk is $100, right? And the loss size you will input on your MetaTrader 5 is 0.4 lot size. So that is the step 2 that you need to master, your risk management. Remember, if you stick to this risk management approach, that means it's going to take you 10 trades before you blow your account. So you can lose first trade, second trade, third trade. Don't panic. Maintain your discipline. Losses are inevitable. You are going to encounter losses, right? But be disciplined all through, because you have programmed your approach, your risk management, that it will take you 10 trades before you lose this account. So you have to maintain that. So what you are going to do now is to move to the third step, which is the patience. So patience for you to wait for trade to come to your point of interest. That is another difficult skills for beginner trader to overcome. A lot of beginner traders, they are not patient enough. So what you want to do is to wait for price action to sell down to your point of interest. And if you look at what the price action is doing right now, price is approaching our point of interest. So price is not yet at our point of interest around this zone here. This is the current price position. And this is where we want the price action to mitigate before we execute. So don't force yourself to start buying around this zone here. If not, you are going to give free money to the market. So you have to exercise a lot of patience. Let the price action mitigate your point of interest before you execute your trade. Let's play the candlestick. Now that the price action is already at our point of interest, then you have to use my entry criteria rules. That's why I use counter trend line. So as the price action is approaching my point of interest, I make use of counter trend line by connecting 2 points together, then extend it below my point of interest. So what I'm going to do is to exercise a lot of patience and wait for price action to invalidate this counter trend line to the upper side before I execute. I'm going to look for other possible counter trend line that I can establish. So I can establish another counter trend line here. So here right now, I'm having two counter trend lines that I can use for my positions. Since trader A is risking $100 per trade and you're having two entry positions around this zone here, so you're not going to risk the whole $100 on one position, right? So you have to split it to $50 each. $50 each. So you risk $50 for entry 1, then another $50 for entry 2. So let's play the candlestick so that you can understand more about this, my trading approach. So look at what the price action is doing now. Finally, the price action mitigated the first counter trend line, which is our first entry. Then you execute your trade around this zone here. You put your stop loss below. Then you are going to target the next major key level zone depending on your risk appetite. So that is my entry 1. So I will allow my first $50 entry to keep on running before I execute my other trade. You can see that when we enter this trade, the price action moved in our favor, few pips to the upper side. Then the sellers came in, they sold the price action back to our stop loss zone. Imagine you have risked the whole $100 on single entry. It might have a little negative effect on your psychology. So that is why I love to split my risk on a single trade into 2 entries by using my counter trend line. So looking at this trade right now, as a trader, you have to master how to withstand drawdown when price action is moving towards your stop loss zone. You have to be able to withstand that emotion when price action is going against you, so that you will not close your trade, you will not exit out of the trade. Meanwhile, price is just retracing and price is still going to go in your favor in the long run. So the price action now invalidated our second trend line entry here. Then we're going to close our stop loss zone around this place there. So our final take profit is now going to be at this major swing resistant key level zone. So we're having 2 entries, 2 positions. So the first position will risk $50, the second one will risk another $50, making a total summation of $100 on a single trade, because that is the risk management appetite of trader A. So let's play the candlestick and see what the price action is doing right now. So price action is moving back to our stop loss zone. So we have to be patient. You have to understand that price action can't just move in one direction. Price will buy, then we sell, buy, sell, buy until the price action reaches your destination. So let's keep on playing the candlestick. Now price action is moving to our point of exit, our take profit level zone. So let's play the candlestick. Let's play price action finally smashed our take profit level. If you find value in this video and you want to be part of our free signal community on Telegram, where we give out profitable signals to our community every week, and we also hold free webinar session on trading every week on Tuesday 10 a.m. to 11 a.m. Don't forget to click the link below this video description so that you can be part of these lucky traders that are enjoying our exclusive trading information, trading knowledge for free. And I will see you in our Telegram free signal community. And also don't forget to click on the like, subscribe, and turn on the notification button so that you can get notified when next we upload another excellent video tutorial like this. And I will see you next time.